we've got the PAT down to 1.13 billion naira, translating into earnings per share of 7 kobo. The company down, but certainly not out at this stage. To what extent is the rot now out of the Skye Bank system?
Well, thank you very much. Good afternoon. I think there's a big drop in PBT, and that is largely driven by the provisions that you have in respect of the margin loans and a couple of other loans. You must remember that sometimes last year we had the audit, and we did tell the market that we would break even, that there would be significant recoveries. In fact, there were recoveries in excess of 10 billion naira in the last quarter of the year, and that explains how the bank was able to move from a loss of about 12 billion and break even to achieve a PBT of 2 billion in the last quarter. So largely it's down to the provisions, and we've cleaned up the books. We've provided for all of the margin loans and whatever other classified assets are on the books. So going into the future, we're confident. We've taken care of the bad loans. We're on course for recoveries. We think that we'll make between 12 and 14 billion in additional recoveries this financial year. Yeah. Deposit rates have dropped significantly. Market rates on the average are about 5%. As a mid-tier bank, we stand to benefit a great deal from that. Same time last year, rate on fixed deposits was 14, 15, 16. Today, we're looking at 5% and lower than that. So that will impact very positively on our net interest margins. And we think that this will be a good year for Skye Bank.
Well, what risk mitigating strategies are you employing at this stage, given the lessons that you've learned over the recent past, to manage the quality and the asset quality that you're actually taking on here, where we have seen your loan portfolio increasing 28.7%?
Well, it all boils down to risk management, credit risk management, operational and liquidity risk management. We have tighter controls. There's a much better market definition in terms of the sectors of the economy that we're going to be playing in. I must also remind you that what we had was less than 10% of the portfolio really in the margin loan sector, which was the cause of the challenge that we had on the results. But it's all down to much more focused and qualitative risk management. We've defined sectors that we want to play in. We've identified the companies that we're going to be doing business with. And we think that going into the future, I think the regulator has also done a couple of positives. There's a new set of prudential guidelines, which clearly spells out the new provisioning regime, and the new provisioning regime is quite well disposed towards long-term projects. Yeah. So we think going forward, the challenges that we've faced on the loan book is over, and we've learned our lessons.
So if we take a look at your loan book then, and exposure that you are exposed to, I mean, a lot of focus has been placed on quality earnings potential. What kind of diversification are we seeing in your loan book, and what route are you taking in terms of the asset quality you're taking on right now?
Okay, it's a fairly well diversified portfolio. Oil and gas upstream. We do a couple of players on the downstream. We're involved in hospitality, the hotel business, in construction and education. These are fairly long-term in nature. Fortunately, the central bank has also released, or has put out about 3 or 4 funds now to help with the financing of such long-term projects. And only this morning we received about $43 million to refinance a couple of our agric and agro-allied related projects. We received that from the central bank. It's at 0%. It's for a tenure of 7 years. So increased diversification. Yeah. Upstream, we're playing the marginal oil fields. Downstream, hospitality, the new Intercontinental Hotel, agro-allied, cocoa export, construction, and of course education. So it's I think the top 50 loans will probably account for about 50–60% of the loan book. So it's a well-diversified portfolio.
Well, that...
And I think when we also do the conference call, we would further highlight that.
Well, that's certainly highlighting some of the risk mitigating strategies you're currently employing. How are you positioning the bank in terms of opportunities for mergers and acquisitions? Because the company at one stage had been surrounded by a lot of speculation that it, amongst other tier 2 banks, will take advantage of the market environment to actually buy scale and position the business for leadership status moving forward. What's your position now in that regard?
Okay, first, I think Skye is increasingly getting the scale it wants on its own organic growth. On a number of indices, when it comes to size, Skye will probably be ranked 5th at the top of the tier 2 banks. So scale will come organically. So we're not in a hurry to go into an M&A. We've been approached with their discussions, and at some point we'll conduct a due diligence exercise on 1 or 2 financial institutions. Now, if we're happy, if the price is right, if the regulator provides the kind of mitigants or forbearances that we hope they will, then we might go into. But the business opportunities are there. I mean, there are quite a number of banks under administration, so there's an opportunity for organic growth. So if an M&A comes, it's okay. If it doesn't, then we just go ahead and continue to grow organically.
So organic growth is the focus when it comes to home ground. Looking at your regional plans, I mean, we've got Skye Bank having opened operations in Guinea, but you've also mentioned looking at Ghana, Liberia as well, Angola, DRC. What's your strategy when it comes to extending your regional footprint? Are you looking at organic growth in that regard as well?
Yes, we are looking at organic growth. Our focus has been first and foremost on the Mano River region. The Mano River region is Sierra Leone, Liberia, Guinea, and Gambia. Now, we're in 3 of those countries. Ghana is the 2nd largest economy in our sub-region, so we're likely to continue to look at Ghana, and there are opportunities there. It is unlikely that we go towards the east for now. I think we'll remain within West Africa, with particular focus on the Mano River region because of the opportunities in the mineral extraction industry there, because for the first time in several decades, there's some level of political stability. The Chinese are back in there. Rio Tinto, a couple of the mining companies are also taking huge stakes. So we think that business will do very well in the Mano River region, especially in Sierra Leone and Guinea.